Good evening, traders and investors. Will back here with another one, coming to you with a Thursday market recap. Hopefully all of you have been well and have been able to navigate the turmoil that's currently in the market landscape without too much anxiety. Now, it's been roughly a week since we've seen each other, and my apologies for not uploading, guys. I was on my last leg of my Asia travels from Thailand to Singapore to Japan, all in roughly 4.5 days. Did not have much time to upload, but we are now back to our regular scheduled programming from Monday to Friday after the close. But of course, since the last time we've seen each other, a lot of things have happened and the moves to the downside have been accelerated. So in today's video, we definitely have a lot of things to talk about. We are going to go over exactly what's been happening over the last 5-6 days of trade, both in terms of the political developments, but also in terms of the macroeconomic data points that have come out front and center in the last roughly 5-6 days of trading, which have led to some very volatile moves, namely to the downside. So in today's video, number one, we're going to be doing a summary recap of everything that's happening both on two fronts: the dwindling of macroeconomic data across the US economy and also in other parts of the world. And number two, of course, delve into the Trump administration policies and their impacts on the market as well. I will be giving my opinion on the markets, not so much on the direction of the politics aspect of it, as I try to remain as most politically neutral on the channel as humanly possible. But I will be giving a quick synopsis. Is it time to sell everything? Is it time to buy? That is what we're going to make a determination after going over the points in an objective fashion. Number two, we have to tackle one corporate earnings that had earnings today, which is going to be Costco. They had earnings after the bell. Now, I know we had Broadcom as well, and we had Marvell early this morning, part of the semiconductor plays. We will be doing those tomorrow because a lot of the focus in the first part of the video will be explaining what's happening in the markets right now. That segment should take 10 to 15 minutes. Then we're going to spend roughly about 5 to 7 minutes on those Costco earnings. And then we're going to spend a whole lot of time doing technical analysis on our charts, the SPY, the QQQ, all of the minor sectors as well. Check on the sector rotation if there is any to speak of. And thereafter, guys, dive into our big tech names as well, because big tech, a lot of these names are off 15-20% from their all-time highs. Are they good buying opportunities, or should it be more prudent to possibly wait on the sidelines and wait for all of this volatility to be priced into the markets and revisit these names at a later time? So that's going to be everything for today. Tomorrow, as I said, I'll be doing the AVGO Broadcom, the Marvell earnings as well, take a quick glimpse into semiconductors. And tomorrow, I'll be also doing a full portfolio review for the trading portfolio for the YouTube account and giving my impressions and trade ideas moving forward for at least the next 30, 60, 90 days in this very tumultuous and volatile market environment. So a lot to talk about in today's video, guys. Let's jump right into the action, shall we? So the SPY down another 1.78% today, coming into its 200 EMA, and the Qs as well down 2.75%. Another disastrous day for technology and growth overall, closing below their 200-day EMA. This is the first close below the 200-day EMA, guys, in roughly a year and a half, October 2023, when it closed one single candle below the 200-day EMA. That is the only time you'd have to go all the way back to the banking crisis in March of 2023 to find similar closes. Suffice to say, the volatility is here, and the volatility might just be here to stay as well. Taking a look at our sector rotation, well, there was not much sector rotation today. There was a few outperforming names in terms of consumer defensives, a few healthcare names that performed well, a few energy players, but for the most part, the destruction was had across financials and the banks, the credit cards. Nothing was spared there. And technology, whether it be the infrastructure play, hardware plays, or software plays, everything was down pretty much equally across the board, with the major losses here in semiconductors to cap off a very brutal day in the markets once again. Real estate and utilities not cooperating there as well. So suffice to say, this, guys, when you say a lack of rotation into the major sectors, when you see days where all of the major sectors are dropping and clipping into the lows at the same time, this is fear-driven selling, and this is synonymous with money leaving the market. I was telling you guys to pay special attention to the rotations up here, because up here, the market rotations were still healthy. Tech was dropping, but financials and healthcare were supporting the SPY. However, when you come into an environment where several days now at this point in time, you're seeing money categorically exit the markets, and whenever we have green days, they are mostly attributed to short covering. That is not a very good sign in terms of the short and medium term direction for the markets either. And the safe haven trades are really not coming alive at that point either. The bonds are down, and even a trade like gold is down as well, not skyrocketing. happening. So really at this point in time, guys, there isn't many sectors, many industries that are safe in the markets, and we need to be approaching these markets with a lot of caution moving forward. There's a ton of moving parts. There is volatility catalysts coming at us from all directions, guys. Political events, not only at home, but abroad. Number two, macroeconomic data points that just seem to be degrading. The US economy was already relatively on thin ice leading into this year as jobs numbers and inflation numbers were front and center with a shaky consumer, unwilling to spend more than they could afford, which led the US economy to be on shaky footing and, in other words, on thin ice. Now, when you exacerbate that problem with possibly tariffs, geopolitical tensions, and just a overall consumer sentiment that is far below what it was at this point in time last year, you end up with a resulting market that is just throwing an absolute tantrum in every single direction possible as institutions and retail traders alike start to de-risk some bets as they do not enjoy the current volatility in the market. Moving into the one-day relative performance, guys, you'll see that it was not very good. Every single sector in the S&P was dropping today. On the 1 week relative, you still have some gains in healthcare, basic materials, and defensives, but those were quickly eroding over the course of the day today. Everything else at the downside. And now on the 1 month relative basis, guys, you are pretty much negative across everything except for defensives, real estate, and healthcare, which leads us into a picture that looks like this. The SPY has erased all of the gains since that November election rally. The Qs has erased all those gains and a little bit more since the election rally started. And overall, the Qs remain right now year to date down about 5%. The SPY is down roughly year to date, roughly 2.83%. But in the last roughly 10 days of trading, guys, this is a big drop, right? Not correction territory for the SPY. It's down about 7. And the QQQs, however, top to bottom at this point, almost 10%. 10% is your theoretical correction level. And I would not be surprised tomorrow, since we have the non-farm payrolls, if those jobs numbers are bad, guys, we get another red day, that will be officially correction territory for the Qs. And unfortunately for us, we are not yet daily oversold. So before we get into more technical analysis, guys, let us dive into exactly what's been happening, because we have not talked to each other since all the way back there on the Qs and all the way back up here on the SPY as well. There is a number of factors at play, right? And the best scenario or the best description, guys, that I could give you about this market scenario right now is that for me personally, you guys have followed me along through this investing journey for the past 2 years. And a lot of these moves have been very easy to call the bluffs on overall, right? Number one, the first move that was easy to call the bluffs on was the banking crisis back in March of 2023. That was roughly around when I started my channel in the midst of the small and regional banking crisis. Now, the large banks were well capitalized. The problems were very niched down to a few institutions. And overall, it was a very somewhat easy bluff to call if you were looking at the proper data and following the Fed that the banks were sound and resilient, and the fact that the Fed was also looking to backstop a number of these banks in terms of if the situation would have really degraded. Consumer credit quality was also not too bad, and commercial grade quality in terms of institutional loans towards commercial real estate also was concentrated risk to certain institutions, but the large banks had a very diversified portfolio, so the pain was not broad-based. This was an easy bluff to call. Bluff number two that was relatively easy to call was the first inflation resurgence scare in fall of 2023. Now, the underlying consumer at that point in time was still somewhat resilient. The consumer discretionary spending was still also somewhat high. The GDP numbers were high as well. We had the AI trade front and center on everybody's minds with productivity increases. And for the most part, there weren't as many geopolitical tensions as there were today, right? So this, as a whole, this bluff as well was easy to call out because we had a few limiting factors that were pulling down the markets in terms of an immediate narrative in terms of inflation, right? But it was only a few components of inflation that were posing problems to the market, namely in the services sector as goods continued to follow a disinflationary path. Correction number three, well, not quite correction, but sell-off number three over here was in April. Same inflation concerns. January, February, and March data in 2024 came in slightly hotter than expected, but overall the backdrop of the economy in terms of the jobs market and GDP outlook was still healthy. Corporate earnings were also guiding higher. This too was a relatively easy bluff to call. The Japanese carry trade, same thing. Inflation resurgence fears, a pivot from growth over to value as some growth came under question, but thereafter we got some corporate earnings for Q3. It showed that the economy economy was still relatively healthy, GDP was still healthy, inflation was still overall on a bumpy downtrend, and the Fed was still very confident in its positioning in the markets. This too, you guys saw on the channel, it was a very easy bluff to call, and you did see me buy some of these lows. And after that, we come to this one right here. We can talk about Powell, and we talked about Powell a lot in January, how there was a lot of volatility catalysts, but that the overall direction of the economy was still healthy. Consumer confidence, although slightly down, was still healthy, and we did not have the sheer amount of catalysts being thrown at us as we do have today. So the economy was on slightly thin ice as we transitioned from the Biden administration over to the Trump administration, but there was a lot of optimism coming into the Trump administration as well. And here we are today. Now, for dip number, let's call it 4 or 5, or the past 2 years, a considerable correction in terms of the SPY and the QQQs. But this time, guys, this time, in my opinion, is different. There are a lot of volatility catalysts currently being thrown at us from all sides. It is not only inflation, it is not only consumer confidence, it is not only geopolitical conflicts, it is everything and the kitchen sink. And when it is a case of everything and the kitchen sink, and you are seeing foreign governments battle it out in terms of who can play the best game of chicken, whose economy is going to suffer the least, because everyone will suffer if the direction continues as it is right now, that is when you kind of have to say, as you're on the poker table, right? Sometimes you cannot call these market bluffs anymore, depending on the account that you're in. You guys know I have 2 accounts, a trading account and a long-term portfolio. I'm a firm believer of always dollar cost averaging into a long-term portfolio, although there are some times you want to raise more cash than not, and this would definitely be one of them. For a trading account at this time, to be calling this a local bottom or the absolute bottom, I think would be somewhat imprudent and lack of proper risk management. Let me explain as we go through these catalysts. Here are the volatility events that we currently face, and you will see, guys, they go over and above what is only plaguing the US economy right now. It is now a global intertwined situation where we have one camp, the United States and the Trump administration, and the ideological politics that go with that, and the entire rest of the globe, and the economic status of the rest of the globe, and the ideological political stance that the rest of the globe has. It is, for all intents and purposes, a purely political driven market at this point. And when you start coming into politically driven market narratives, because you guys know I always say, the market is a game of narratives. Yes, mostly the market is based on fundamentals, but a lot of times the market is also based on the prevailing narratives at hand, and we have to recognize them. You may agree with the narrative right now, you may not agree with the narrative right now, but you have to see the narrative for what it is and decompose the narrative into its respective parts, and then make a decision as a trader whether or not you are willing to call the market's bluff on this decline, whether or not the declines are coming to an end, or whether or not this may be the start of something worse, namely a possible stagflationary recession, or more off, a global recession resulting from an impending trade war, right? We're going to get into that right now, and I will stay apolitical. I'm just going to give you guys the facts without commenting on whether I agree with the narrative, whether I disagree with the narrative, and I will give my opinion at the end to say whether or not it's a good time as a trader to stay in the markets, and also a long-term investor if your time horizon is 5, 10, 15, 20 years. Which of the 2 accounts should be maintained in the market? Which of the 2 accounts should be protected versus not? And what I am doing as well. So let's go over the catalyst, shall we? Number 1, of course, front and center has to be the tariffs. Now, I cannot begin to explain how many times in the last 2-3 weeks, the Trump administration has flip-flopped on the tariffs, right? First off, the tariffs were supposed to be Mexico, Canada, and China for 25% and increasing if there was any retaliation. That was then put up in the air, whether or not it was going to happen. It finally happened in the early stages of March, just this past week. And now a lot of items just today through the resulting new NAFTA agreement, the USCMCA or something like that. The acronym, right? I didn't write it down, but it's pretty much NAFTA, the new NAFTA that Trump renegotiated back in 2020, 2019. Well, now certain of those products are exempt. You are seeing constant flip-flopping and constant renegotiations, right? The one thing I always remind you guys is the market does not like uncertainty. And when you keep flip-flopping on the narrative, you give the markets more and more uncertainty. Now, some of you will argue that this is the way Trump operates. It is in his book, The Art of the Deal. Give very lofty demands, pretty much insert a lot of uncertainty in the negotiation tables, negotiate for something very high, and then meet somewhere in the middle. That is completely normal. That is his style of negotiating. I'm not here to say if that is a good thing or a bad thing in terms of negotiations. But one thing that it does do necessarily is it erodes not only retail confidence in the markets, but institutional confidence in the markets as well, because we know that depending on the economic studies that you look at, tariffs can either be a net benefit for a country or a net negative. You cannot convince everybody of your opinion in terms of those facts. The data will be the data, and we will see the data as it evolves. But we have a constant push and pull between two parties right now, some of which believes tariffs will be a net positive for the USA, some of which will believe it is a net negative. One thing is for sure, Trump is trying to solve the trade deficit that the United States has right now. If we take a look at the trade deficit overall, guys, you will see that the trade deficit has been accumulating over roughly the last 5 years, now almost to the tune of, let's call it about 1.2 billion in terms of goods, in terms of a deficit in terms of goods. However, we are running a $293 billion surplus in terms of services. So the USA is a net exporter of services, but a net importer of goods in terms of the trade deficits that it's having. And Trump is seeking to resolve this and result the economy overall in terms of a net neutral status or a net surplus. So there's a lot of work to do there. You can understand the arguments that the United States wants its fair share. You can make the argument that other countries tariff the United States a lot more than the United States tariffs other countries. And Trump is looking for fair play and fair practice across the board. But once again, it does insert a lot of volatility, and it does lead to a narrative that has been presented now by a lot of the media, which is going to possibly lead to inflation for the American consumer. You can also make the argument that the American consumer can substitute away a lot of the goods that it imports for goods that are locally made, and that the Trump administration is trying to onshore manufacturing. But I will remind you, as part of the globalization of the economy, it is one thing to possibly, reshore or shore back the manufacturing onto U.S. territory, but there's a reason that a lot of goods are made abroad and then either assembled or brought back to the consumer here for purchase, final goods, that is, in the United States, because it's a lot cheaper to do it overseas. There's a lot of unions in the United States, and the cost of production, if everything were to be made in the United States, would result in higher prices for the consumer. Why is this a problem? Because consumer discretionary spending has been very, very tight for the last year. So when you start exacerbating that narrative, it leads to a lot of pain in the markets, right? With an already tapped out consumer that is slightly struggling right now with the inflation of the last few years. Also noteworthy to add that the United States is usually an exporter of their own inflation. The US economy is a consumption economy, guys. It is a debt-driven and consumption-driven economy overall. The way that this works is they are usually exporting inflation via US dollars that obviously are shipped out to foreign nations in terms of trade, and that gives the US consumer better prices. It results obviously in the erosion of the fiat system for other nations, but keeps the US dollar strong overall. This is what's called exporting inflation. When you try to shore up the manufacturing and solve the trade deficit, you do away with arguably the United States' largest competitive advantage. These are very, very, very complex economic takes right now that are battling themselves out in the markets, which is why you're seeing such violent upswings and downswings whenever tariffs come into play, right? So that is the battle of narratives that is happening right now in terms of tariffs. I will let you guys be the determining factor on whether or not your stance is it's going to be a net positive or a net negative for the economy. There are studies that show that it can be either direction. Now, moving on to number 2, the government jobs restructuring. We know that a lot of people on my channel as well have been saying that the jobs numbers have been quote unquote fake for the last year and a half, as they've been bolstered by a lot lot of government jobs. Some of you can argue that the amount of government jobs are excessive and that productivity within the government is not very high, and that maybe some of those jobs or some of those departments should not be in place in the first place. That is a perfectly logical opinion for you to possibly have. However, one thing that it will contribute to is lower jobs numbers and possibly rising unemployment. At face value, those two things are not good, especially when you have a jobs market that is teetering right now between healthy and unhealthy. The unemployment rate is low, but we know that net new job creation is not at the highest standards that it has been in the last 5 to 6 years. And we know that the markets are only on thin ice right now because we're still struggling with heightened inflation, and we're looking very closely at every single jobs report that comes out because that is what the Fed is looking at as well. That is their second mandate. Number one is number one is managing expectations, managing inflation to target, and number two is maximum employment. Of course, if we do not have maximum employment because a lot of government workers are either fired or quit, that is going to show up in the numbers, and that is what the market is trying to price in as well. Will that cascade? If a lot of government workers, which are highly paid government workers, lose their jobs, they cannot spend the money into the economy. And that is obviously a wheel effect, which will bring down the growth of the economy overall, because the government job sector is a very large sector overall in the economy. That is volatility catalyst number 2. It is up to you to determine whether or not the reduction of the government workforce is a good thing or a bad thing for the economy. Some people say that short term is going to be painful, and this is the exact words coming out of the Trump administration today. There will be short-term pain, but overall it is a net positive for the economy long term. His words, not mine. Also up to you to make that determination. I'm just here to say what is impacting the markets in a big way. Number 3 is the Ukraine situation, which remains unresolved. Of course, everybody knows about the meeting that was had between President and Vice President Trump and JD Vance and President Zelensky of Ukraine, of course, in the last Friday session, which, to use choice words, did not go quite as planned. That situation remains unresolved, which has led to an infrastructure spend as the US is now backing out of military assistance towards Ukraine, as they do not want to fund that conflict any longer. They believe that the most of the funding should indeed come from European nations due to their proximity to the conflict. So they are reducing infrastructure spend, which is going to save money for the United States. But obviously, in terms of political commentary and the narrative at hand, it is not going to be very good for the resolution of the war, which is what Trump obviously ran on during his presidential election, during the rallies and everything leading up to the election, right? That was one of the major points that he ran on, was solving the war quickly. And now, as the war remains in an unresolved situation, obviously that exacerbates more volatility in the markets right now. This infrastructure spend, which was declared by European nations to the tune of $500 billion over the last few days, as the United States pulls back its own funding, Europe has to obviously increase its funding. This has led to something, guys, that you do not want to see. This has led to number one, a Eurobond sell-off, which came out fresh this morning. If you guys are wondering why the markets dropped so hard in the pre-market early this morning from about 245, this was the European session. Why? Well, the bond market extends sell-off after seismic German spending plan, right? €500 billion shift in German defense and infrastructure spending. The ECB also cut its interest rates again as expected and said monetary policy was becoming less restrictive. I'll show you guys the stats in a minute, and it is somewhat troubling. We know that Europe does not have the strongest economy right now. The reason the bond market is falling is the same reason that when Jerome Powell cut interest rates in October, the 10 and 20-year yields rose in the United States. This is bond traders calling out the bluff of the European nations' ability to, number one, service their debt, and number two, add to that debt with this increase in defense spending. A global bond market sell-off still in full swing a day after the 10-year German bond yield, a major driver in worldwide borrowing costs, saw its biggest rise since the 1990s. Look at this chart. This is exactly what happened when Jerome Powell cut interest rates. The ECB cut interest rates again while maintaining spending the same. And bond traders across the globe are calling the bluff. They do not want to pay this risk premium. They think that things are going to get worse before they get better. As such, they are not buying the dips. They will either short these bonds until they're getting adequate risk premium to lock in their money for a 10-year time horizon. It's exactly the same type of move we saw on the 10 and 20-year yields in the United States when bond traders called out the bluff that inflation was probably not done and that the Fed was probably cutting too soon. This is what's happening. They are calling out the bluff that the European Union is potentially not yet done with inflation, possibly due to the tariff implications that are coming over the next maybe 3 to 6 months for European nations. Right? Wednesday's bond yield spike was the biggest move since the German reunification in 1990. Japan as well. The 10-year government bond yield, another key driver of worldwide borrowing costs, had hit a 16-year high over the course of the same session, guys. This is not good. When you see a global bond market sell-off, guys, this is one thing today that nobody talked about. Everybody talked about the tariffs today. Nobody talked about the Eurobond sell-off and the global bond market sell-off overall. If you have big money and fast money not willing to buy the dips on 10 and 20-year treasuries, the same of which happened to the US 10 and 20-year treasuries, guys, that is big money calling the bluff of the central banks that they are ill-positioned for the economic turmoil that may be coming to them in the next 3, 6, 9 months. That is not good. When you see a global bond market sell-off hitting record levels as it is right now, a big red alarm bell has to flash in your minds. I rarely give these warnings on the channel because I do not like being a market bear. But when you see, guys, and everybody in finance knows this, whenever you see a global bond market sell-off in the context of central banks cutting interest rates, which is contrary to what they should do, a big warning signal has to be flashing in your minds that very large players are making very large bets, calling the bluff, saying that things are not as rosy as they're portrayed to be, right? Take a look at all these numbers right here. The inflation rate for the European Union is not too bad right now, sitting about 2.4%, right? Look at the data, it's 2.4, same as ours, roughly bumpy, but 2.4. But a lot of tariff expectations and infrastructure and spending that the European Union now is reiterating that might lead to inflation going higher. Why is this a problem? Because their GDP growth rate right now is only 0.9% on a year-over-year basis. That is very, very low, guys. You cannot have a resurgence of inflation with GDP only at 0.9%. That is stagflationary concerns. That is why the bond market is selling off and why our own bonds also have not recovered. The scenario that we're looking at now globally, not only in the US, but also in the European Unions as well, is one of a possible stagflationary recessionary narrative. And that is not a good scenario because the interest bank, the overall central banks, guys, do not have tools to solve that. If inflation goes higher and the growth rate is not there, you really don't have much to solve those issues, especially not when your government debt level is sitting at about 88% of your GDP. It is down from 96%, but still, guys, this is not good. Europe cannot afford to be spending this money right now. If people are concerned with the US debt ceiling, which just got increased, well, the European one is not all that better. That is why you're seeing the global bond market sell off as traders are wanting to be more and more compensated for taking on the risk of locking away their money for 10 years. It's the exact same thing that happens here. It seems counter-logical at first, right? But that is the nature of risk premium. You have to pay special attention to this right here. It is extremely important, which is why I say this whole Ukraine situation, guys, is larger than only what happened last Friday between Trump, Vance, and Zelensky. Number 4, manufacturing pull forward. Obviously, with inflation, we've seen a ton of manufacturing pull forward. We can go back here in the most recent few weeks of data, and you will see S&P Global Manufacturing PMI prices paid were higher because people are trying to front run the impact of tariffs overall. You can also see it in net new orders. Durable good orders were up 3.1 versus 2%. All the orders at manufacturing are higher than expected. Why? Because people are trying to front run the effect of the tariffs, buying things now before tariffs are implemented. That way they can build up inventory, right? That also, guys, is putting pressure on prices to the upside, as right now demand is very high, but when the tariffs come in, that demand, yes, the demand will come down, but the prices will be equal. So you're putting a lot of pressure in terms of pricing for manufacturing and final goods orders as well. Services inflation remains still high, as we saw in the most recent CPI print roughly 2 weeks ago at this point. Number 6, consumer confidence and consumer sentiment. Now, of course, these are subjective. These are, of course, surveys, and depending on which way the respondents lean in terms of political standards, they will respond one way or another. Inflation expectations are also tied into there as well, right? We have inflation expectations in terms of consumer expectations that have now oscillated between 3.5 to 4.5%. Now, the Republican people who answer those surveys are between 2.5 and 3% for inflation over the next 1 year. The Democratic people who answer those surveys, their expectations are between 3.5 to 4.5%. So obviously people's political bias is skewing their answers to these questions. However, it does give you a few numbers when you look back at consumer confidence and consumer sentiment, as we saw most recently in the past few days. If I can find it real quick here, let me just look for it real quick. You guys remember the just personal consumption? I can't find it right here, but you guys know what I'm talking about, right? Consumer confidence, and let me see if I can just quick search it real quick on this consumer. There you go. Michigan Consumer Sentiment Index, right? Down. There's the U of Michigan survey overall. And then you probably have the consumer confidence one, consumer confidence here, which unfortunately is not on the chart here for February, but that one was also down as well. So those two things are weighing on the markets as consumers start to largely price in the impact of all these economic policies. Then we had the GDP Now projections, right, where we saw this one drop from 2.3%, which was the expectation on a first quarter moving forward rolling basis. That is now tapered back to about between the range of 1.5 to 1.9% in terms of final domestic sales and the GDP nowcast. So we have dwindling numbers there as well. That was a very, very, very negative print that did not help the markets. And lastly, guys, I'll include this one first, right? You have people like Warren Buffett just a few days ago coming out saying that tariffs would indeed probably lead to consumer-facing inflation. Target, Costco today with earnings, Walmart and Best Buy in the most recent days and weeks also warning that these tariffs would be somewhat a struggle to deal with in terms of consumer pricing with an already weakened consumer in terms of discretionary spending, which leads me to the last point, guys. The Globalist Alliance versus the USA. These are Trump's words today, not mine, right? So Trump today came out and said he's not even looking at the stock market. Tariffs will make the US very strong. When asked whether the decision to pause tariffs on many products from Canada and Mexico for 1 month was due to the stock market, Trump said the decision had nothing to do with the market. I'm not even looking at the market because long-term the US will be very strong with what's happening here. Second, Trump was later asked again about the market sell-off and blamed globalists. I think it's globalists that see how rich our country is going to be and they don't like it. Big market out there. But again, they've been ripping off this country for years and they're going to do great. Everyone's going to do great, but we can't let this continue to happen to America. Otherwise, we're not going to have a country any longer. So the Globalist Alliance, to quote President Trump, not myself, versus the United States. Now, we had something similar back in 2018. I'll remind you the context of 2018, however. The United States had little to no inflation whatsoever. They also had a budget that was also well within their means and a debt to GDP level that was a lot more conducive to hardball negotiations. This was before the ballooning of the debt cycle that happened after COVID, as the government was bailing out the consumer and institutions alike, left, right, and center with stimulus packages. Well, we had a much better debt to GDP level, and the United States was in a much better position for these hardball negotiations. I'll remind you at the time, the US was by large and by far the highest performing economy in the world. They were still above China. They were well beyond Europe and all of the above. And now, however, the tides have flipped. Back then, the United States had a ton of leverage. These are just hard, cold facts on paper when measuring debt to GDP and when measuring overall global productivity output. Now, with the fact that the USA is still struggling a bit with sticky inflation, the fact that the jobs market is also showing to be resilient, but any weakening in the jobs market will be magnified and will possibly start a snowball effect, right? The US economy is still relatively on thin ice as consumers are still struggling with the effects of inflation. And we know consumers represent a very large portion of the United States GDP. So if I were to tell the truth here, guys, the US is not operating with the same amount of strong arm ability and the same amount of leverage as it was 5, 6, 7 years ago at this point, which is why you have the globalist alliance, namely European nations, several Latin American nations as well. A lot of nations are now coming together and trying to to give a quote, right? They're trying to stick it to the man. They're trying not, at least, to be strong-armed by President Trump this time around, which is why you're seeing all of these countries come together this time. I'll give you a quick example. In Canada, it's very difficult to get Canadian nationalism to rile up. Very difficult. Trust me, I've been living here my entire life. Usually our prime ministers really don't like communicating with each other and making concessions amongst each other. It only took Trump to implement tariffs on us for the entire nation to come together, all of our prime ministers to come together, a sense of nationalism. And I'm not saying I'm included in that, but now everybody wants to boycott United States products, removing alcohol from the shelves, canceling trips to the United States. Now, you guys might not think that's a problem, but this is happening all across the globe, guys. This is happening in Mexico. This is also happening in Europe as well. So it's a question of they're all standing together against the United States. Now, the United States is a very strong economy, as they should be. However, are they as strong as all of these other nations combined? Possibly so. But do you want to play a game of chicken when the global economy is already still weak after the results of the pandemic? We know that Europe is not the strongest. Even here in Canada, guys, we are still not back to the former glories of before the pandemic, and neither is the United States. I am here saying that right now, what we're currently seeing, the United States is trying to play hardball with the rest of the world, but this time the rest of the world may just not roll over. We are seeing a game of pretty much recession chicken here. Whose economy will get hit the fastest and the hardest, and who will fold their hand the quickest? That is not a very good recipe for the markets overall, playing a game of chicken like that. So as I say, it is a globalist alliance versus the USA, to quote President Trump. If not, I would just call it a worldwide alliance that does not want to be bullied. Now, this could possibly be due to economic reasons. It could possibly be due to ideological, political reasons as well. As we know, the new Trump administration has a different political ideology view than most nations currently in Europe, then Canada, and then from a lot of countries around the world as well. So that is a constant struggle at hand too. So thin ice versus the amount of leverage that the country had before. And we do not want to see how bad it can get before some people fold, because in this situation, short term at least, there will be no winners. Long term, that's another discussion. But short term, in this situation, there are no winners, guys. Trust me, right? Who will fold first? And now all of the above can slow down the US economy. It can slow down the global economy overall, as seen by the global bond sell-off overall. This, of course, is a self-fulfilling prophecy. If people think a recession is coming as a result of all of this, they will stop spending and start hoarding their money, which slows down consumer spending, slows down companies' revenues, and then if a business thinks a recession is coming, their hiring will slow down and they will start doing layoffs before it starts to hit their profits. This is a self-fulfilling prophecy, which is why you're seeing the sheer amount of declines that you are currently in the overall markets. So this is the combination of all the factors that are affecting the current market environment right now. As you can see, it is a lot deeper than just now calling the bluff on a few characteristics of an inflation trend back here, and back here that was only affecting the United States, but overall that the global economy was moving forward. Trade relations were still good. Geopolitical relations, even though somewhat tedious, of course, between Ukraine and Russia and the situation that happened in the Middle East, were somewhat still relatively manageable. Now it's a question of everything against the kitchen sink, and now we are starting to talk about a global trade war, a global slowdown in economics, and possibly a global recession or stagflationary environment as we get this whole battle of the United States versus essentially everybody else. So that is why, guys, with this combination of factors, the bonds, the equities markets, the trade relations, the tariffs, the geopolitical concerns, right? All that combined makes it extremely, extremely hard to predict where the markets are going to go. It makes it extremely difficult to start to predict or call the bluff as to whether this is the actual bottom or we go into more and more of an extended sell-off, as we cannot resolve these things immediately. The best way you can look at this, guys, is push it to the extreme. Now that we've acknowledged that all these things are a problem, do you see any things here that are solvable within the next 1 to 2 weeks? Probably not. What are the conditions for net new all-time highs on the S&P and the QQQs? Well, you have to resolve all those conflicts, and it has to go back to a market environment where certainty is front and center, and where we do not have any of these economic woes that we currently have right now. In my opinion, those conditions are a long way away from being met. So although, as traders, we would love to say that this is the bottom and just load up on call options and that soon in the next few weeks, we will be at all-time highs, I am just not convinced that this time is the best case to be calling the market's bluff. Not in this situation, guys. This time, I know a lot of people like to say that, but this time is indeed different. There are too many catalysts at play, for me at least personally. You guys do you. There are too many catalysts at play for me to call the bluff here and to say that the markets are finished dropping and that we are closer to the end of the shenanigans and the turmoil and the sell-off than we are to the beginning. This could indeed get a lot worse in the short term. Medium and long term, we will see what the net impacts are going to be on the economy, on productivity, on the American consumer, and on the global trade relations as a whole. But short term, guys, none of these issues can be resolved immediately. As a matter of fact, Trump actually lifted certain tariffs on certain products from Canada and Mexico today. And what did the markets do? They did absolutely nothing. They kept dropping. So it lets you believe that even if he were to remove the tariffs, the damage is already done. The markets do not care. They want utmost clarity, and they think that for now, there might be too much more damage to still come before a lot of these things are mended and clarified, which is why in this video, I will say front and center that for the trading account right now, I am no longer going to be buying these dips very, very aggressively. For the long-term portfolio, of course, every single week, every 2 weeks, I will just proceed to continue to dollar cost average into my portfolios, similar to which I've been doing since 2018 when I started most of my long-term portfolios. But for the trading account, there comes a point in time where you can see clear shifts in every single segment. And when the market becomes one where you can call out a clear bluff, as I've done many times for you guys on the channel, and continue to remain a long buyer of equities in terms of big tech names, in terms of other names that have been undervalued. But you've seen recently, the technicals haven't been mattering. The fundamentals have not been mattering. Everything is just getting sold off regardless, because we now have global uncertainty. And that is a very difficult bluff to call. So that is a very long-winded introduction. It took about 40 minutes to get to this point, guys, but I haven't seen you guys in a week. So hopefully now those topics are clarified, and hopefully now my stance has moved for clarifying. Just quick, right? I'm now pretty much covered up all of my positions and pretty much net neutral. We are now down on the year, 6% in the trading account, which I will show you tomorrow, and that will be the extent of it. My plan for the next 2, 3, 4 weeks is going to be largely sitting in cash and waiting for all of this to blow over. I still have my long-term portfolio. I still have some leap call options that I'm leaving for a risk reversal trade to the upside. But the way that I will be running the wheel strategy moving forward will be somewhat of a pivot and somewhat different. This here is going to be all about preserving capital and not losing any money. So I'm capping the losses where they are today after all this, series of data that we've been getting in the last 2 weeks. And pretty much now, I am not comfortable wanting to call this market's bluff, at least not in a short-term trading account. Will there be space for day trades here and there to the upside, to the downside? Yes, absolutely. But the longer duration swing trade positions for weeks and weeks of recovery as we build momentum behind some trades, I think is going to be very rough, because as you've seen, very, very choppy. You can have very nice 2-3% up days, shut down the very next day, rally, crush, etc. as we move through more and more of this expansion of volatility. I'm not saying the markets are going to do this. I'm also not saying the markets are going to do this. but I am not going to be chopped up by the volatility at the current point, not with swing trade positions. Day trading, fine. Long-term portfolio DCA, fine. But the way that I trade on the channel, guys, the call debit spreads that I let run to the upside for 2, 3, 4 weeks of time, the wheel trades that I put on for 2, 3, 4 weeks of time, those unfortunately have to come to a stop, and we're going to taper back on the risk appetite in the markets. But I will take you along for the journey, and I'll show you more tomorrow what I'm doing in the trading portfolio to protect all the juicy gains we had in 2023 and 2024. For this year to date, we're only down, especially on margin, 6%, which is not too bad. Yes, we gave back a lot of gains from the highs of the year, where we were up 16% just a few short weeks ago, on margin, of course, as well. Now we are just reducing the losses, capping the losses to what they are, and we will sit on the sidelines and identify the best possible opportunities. And I will, of course, be updating you guys with the trading strategies moving forward, as I did do for my Discord today as well. That is a very long-winded introduction. Hopefully you guys enjoyed that one. Now let's dive into Costco earnings, shall we? So moving into Costco earnings, Costco coming in with their earnings after the bell. They dropped, unfortunately, about 1% in the after hours before moving a little bit higher. Let me just put it on here. So you can see that Costco, after their earnings, dropped roughly 2% before now only being down about 1.33%. Now, this was a quarter of somewhat business as usual, but of course, after the Walmart earnings that we covered on the channel 2 weeks ago, there was somewhat of a sour sentiment in the air, especially surrounding the tariffs. We'll look into that with Costco earnings today, but the numbers at first glance were not that bad. Yes, they did miss on EPS by about 2%. They did beat on revenue by about 1% to the upside. Overall, guys, the numbers for Costco were fantastic, as they should be, but you can sense there was a little bit of tension, especially in the way that the questions were answered on the earnings call. Let's move into the slides, shall we? And just the numbers objectively, you will say, were very, very solid. Another very extremely good quarter for Costco. 9.1% growth in terms of net sales, 6.8% in terms of comparable sales, which is fantastic, 5.7% boost in comparable traffic, quarter over quarter measured against Q2 of 2024, 1% average ticket increase, which is fantastic, guys, right? A lot of companies are not able to get not only the ticket price and the foot store traffic up. These numbers are some of the best in the entire industry in terms of your retail shopping companies, right? 20.9% boost in e-commerce comparable sales. Those are all fantastic. If you look at the average comp sales, ticket, and traffic, pretty much across the board here, guys, other than ticket, which was down Canada and international, everything was very, very, very good across the totals of the company, right? Extremely strong. Take a look at net income as well, 2.6% growth. So they are growing their bottom lines despite missing ever so slightly on their EPS number. It was still a 2.6% growth overall in terms of bottom line net profits. Gross margins also expanding at 10.85%, not the most crazy expansion, but still expanding. At least they're expanding quicker than they are expanding the SG&A expenses, which is always a good thing to see. Moving on to the membership numbers, membership at Costco loyalty remains extremely high, guys. 7.4% membership growth income. Only 3% of that came from the price increases that Costco did just last quarter, about a quarter and a half ago. Look at this, guys. 90.5% worldwide membership renewal rate. And in the US specifically, also about 93% overall. They're up 6.8% growth in terms of paid memberships over the year, which is fantastic. And over 140 million cardholders, which is 6.6% growth. Outstanding, guys. Outstanding numbers of loyalty for Costco, which is why it's one of my favorite companies in my own long-term portfolio too. I've been holding this company now for about approximately 6 years, and I've never been disappointed. Costco is really the business that provides, especially in the retail space in terms of shopping retail, right? They, in my opinion, provide the best quality for the value in the entire game, which is why their loyalty is so hard. Their sourcing team, their product sourcing team does such a good job of finding the best quality products and getting fantastic deals on them. And then they do not mark them up too much. Costco's net margins, guys, are very, very, very slim, right? Take a look at Costco's net margins. They're never above a couple percentage points, 2%, not even barely 3%. They pass all those savings on to you, the consumer, which is why they have such a very loyal consumer base to begin with. So that is Costco's business model in a nutshell. Obviously, that e-commerce comparable sales is fantastic, which also proves that Costco is making leaps and bounds in terms of attracting people to their online marketplace, not only on the website, but also utilizing their app a lot more. Site traffic is up 13%, average order value up 10%, deliveries number up 19% as well. So very good for Costco. 43 million visits to the new warehouse tool on the app. Fantastic quarter for Costco, and Costco remains projected to open Costco always opens between, roughly between 20 and 30 stores per year. There's still about 18 stores remain to be open in fiscal year 25, and the company remains in full expansion overall. Nothing to see there at all in terms of the current numbers, but this is what everybody wants to see, right? This is what everybody wants to see. The tariffs. Let's have a look. CEO said although it's difficult to forecast the impact of tariffs, the company aims to minimize cost increases for its members. A third of its US sales are from imports, he said, and less than half of those come from China, Mexico, and Canada. So there is still a decent portion of Costco sales, right? A third of the sales are from imports, and half of that, so 15% of total US sales are from China, Mexico, and Canada. That's not nothing. It is something, right? Yes, can the sourcing team do a good job of potentially finding new products and working their way around the tariffs, or renegotiating the best deals with suppliers? Yes, but there will be some either substitutions there or possibly some price increases for consumers. In uncertain times, our members have historically placed even greater importance on the value of high quality items at great prices. This is true, and our teams will continue to rise to this challenge by leveraging our global buying power, strong supplier relationships, and innovation. Citing tariff implications for groceries specifically, the CEO said margins are much tighter in that area, but that Costco will work with suppliers to mitigate the fallout for consumers. So not admitting yet that it might be tough to find replacement value for those goods, but still, you can tell, right? A note of caution from the CEO saying that Costco will utilize all the tools in its bag to counterbalance the effect of tariffs, but that the tariff implications are front and center for this company, the same as we saw with Walmart earnings 2 weeks ago. Now, moving on further, consumer behavior hasn't changed much over the past few quarters. Costco members are selective with the products they purchased, and would become even more so if tariffs and inflation grow more significant. We believe that the member is probably as much focused now on quality, value, and newness as they have been for quite some time, but they're still showing that willingness to spend. They are still showing the willingness to spend, but if the situation deteriorates and people's perceptions of their job security and perceptions of prices in the future degrade as well, that consumer discretionary spending, which has been somewhat resilient, will also start to taper back as well, which was the warning and guidance that Walmart gave 2 weeks ago. This is all a game about consumer perception and the narratives at play in the market right now. You see why the narratives are so important, right? It's not yet reflected in the data, but here is your cautious tone this time now from Costco. But all things considered, Costco is a fantastic company and consumers will be loyal to them. In terms of valuation here at $1,000, $1,013 in the after hours, you're looking at a 55.9 forward price to earnings. That is one of the highest price to earnings that Costco has traded at in its company's history. Usually you'd like to find this one around a 35 to 40 max, which is still somewhat rich. 5.7 is the peg, but that's not the best ratio considering they're only growing EPS at 9.8% per year. Free cash flow yield of 1.1% is low. It is very tough to make a compelling argument that Costco is good value right now, guys. Starting a position up here is a very tough proposition. Only if you have an extremely long time horizon and you'd be willing to DCA through any dips would I be, well, I can't recommend anything, but would I say that it's not the worst idea to start a position on Costco up here? Only if you can DCA into Costco if the stock does drop, because right now the valuation, guys, is extremely rich. Why is it so rich? Because the company has extreme predictable value, right? The members are so loyal. It is business as usual for Costco every single quarter. And Costco very rarely goes through downturns, only goes through downturns when the overall economy goes through downturns, which is what we potentially might be seeing on the horizon in the next 1 to 3 to 6 months. If Costco, for some which reason, finds itself, and for any point in time, in the $800 handle again, that is when I might consider, even myself, adding to a few shares. The monthly timeframes right now have been overbought for roughly almost a year of time at this point. And when you zoom out to the 3-month time frame, which I very rarely utilize, you will see that Costco oftentimes pulls back to the 3-month EMA. This is the quarterly EMAs. Can we see Costco at some point in time either level off or pull back towards this 12 EMA on the monthly, which would be curling up there? Yes. And that would be roughly in the $800 range. $800 for Costco for me is the area that I consider it to be, even if it would be on paper overvalued at 800, it will be an area that I would be more comfortable adding to any Costco positions overall. And that is my stance on this extremely high quality company that I am very pleased on keeping in my long-term portfolio and that I will not be selling anytime soon. I will be keeping this one for the next 5 to 10 years because the company is just so consistent and so predictable. That is everything for your Costco earnings. Now let's dive into the indexes, guys. Quick glance, this video should be probably about an hour and 15 minutes. So give me a quick little sip of coffee. Let me a second for a sip of coffee and we'll get started in terms of the technicals, shall we? So right now the technicals in terms of Costco, give me a quick second again, guys. So in terms of the technicals on the S&P 500, guys, we know that clearly now the bears are in absolute full control. Lower highs are set, lower lows are now set as well. This is a clear daily downtrend overall, coming very close to the 200-day EMA. Now, overall, we are still not in daily oversold conditions. I would not mind picking up a little bit of a SPY swing trade if we come down into daily oversold conditions and get the flush zone down here, which would be 565 all the way down to roughly 555 on the daily. That is the same area from back here in the month of August, which is also synonymous with the 50-day EMA, or the 50-week EMA rather. Now, we can get a short-term bounce, but just keep in mind, guys, who is in control here of the short and medium-term timeframes? It is the bears. This was a weekly uptrend. This is now an engulfing move to the downside. Any resulting moves higher, pushing on a weekly basis. If we get a minute daily uptrend from here, we will just be looking on the weekly time frame for possibly a lower high. Then it's up to the bulls, depending on the size of the bounce higher. Can we get a new weekly uptrend if some of the conflicts are resolved? Or will the bears capitalize and send us into weekly downtrending territory? This, guys, is the flush zone. This is the 200-day EMA. You close below the 200-day EMA, it becomes a big area of resistance. The last time the SPY closed below the 200-day EMA was all the way back here in October of 2023. And you can see that that situation was not immediately resolved. As a matter of fact, it did put in one big leg lower. So keep that in mind. We can go lower on the indexes. We are not yet oversold. And with the conflicts and the turmoil in the markets still not being resolved, and with the amount of factors at play here, I told you guys as well, they cannot be resolved in one single day, nor perhaps in one single week. So the bears will remain in short-term controls of these technicals. The monthly time frame as well. We are currently seeing monthly consolidation on these indexes. Yes, it is still in the context of a nice monthly uptrend, with the monthly higher lows being set at about 510. However, we are coming back very hard into the 12 EMA. The last time this was tested was once again October of 2023. The chart that I very rarely pull up, guys, I only pull it up when you see after a 2-year rally, the MACD is starting to lose momentum on the monthly. The RSI is now curling over from overbought down to more normalized territory. I pull up the 3-month time frame, and you can see how extended we are from the 12 EMA. This, if things really hit the absolute fan over the course of the next quarter in the markets, this is your max pain flush zone, guys. You're talking about 479 down to about 500, a retest of the 12 EMA. I am not saying this is going to happen. I am saying that if it does get really bad out there, this is the levels that you can be anticipating. So you have to put that into your bear case scenario. There's a bull case scenario, a normal case scenario, and a bear case scenario. This is the bear case scenario. This would be a correction almost on the verge of a bear market, 20% pullback on the SPY. The last time we saw that, of course, was 2022. But you can see throughout the last 10 years of trading, guys, even in the context of bull markets, you had one here, 2015 and 2016. You had one here in 2018, the first tariff temper tantrum, which was also met by Jerome Powell increasing interest rates because the economy was doing a little bit too good. Then you had one during COVID. You had one during the 22 event. It would not be surprising. We have all the cards now, guys. All the cards are on the table. All the cards are on the table for the bear case scenario. Whether it plays out or not, that is to be seen. I'm not saying I have a crystal ball. I'm not trying to predict that this will be the outcome. I'm giving you guys the bear case scenario and why risk management needs to be front and center if you have a trading portfolio in which you are net long, you have to be a little bit cautious moving into this, guys, okay? The Qs largely show the same thing. I'll start on the 3-month time frame. Same principle. Once back in 2015, 2016, expansion of a bull market, retest the 12 on the quarterly time frames. 2018, retest of the 12. This as well was a categorically 22% pullback on the indexes. Once during COVID for very obvious reasons. 2022 was a different market, record levels of inflation and corporate profits and EPS being guided to the downside. Those two things we do not have yet in the markets, but if these catalysts play out, for the bear case scenario, you would not be surprised to see a top to bottom decline on the Qs of roughly a similar amount as we start to normalize and retest that 12 EMA, and then possibly as we move to the other side of this into the late stages of 2025, early 2026, perhaps that can be resolved. This is the bear case scenario. I'm not saying it's going to happen. I'm saying if the bear case scenario comes alive, that is a likely destination for the markets over the next 3 to 6 months. Keep that in mind. Short-term timeframes, daily downtrend is clear as day. This is one single move. The candle from Wednesday did not eclipse the Tuesday close. This is one single leg down. If we bounce from here, looking for a lower high, depends how high the bulls can bounce, and that would be a resulting daily trend change attempt. If the bounce is too weak, we will encounter overhead resistance, 500 to 495, and we'll just be looking for a lower high into lower low, down into the flush zone level below the 200, which would be 482, down to roughly $470 on the Qs, which would be a retest of these levels back here. The 50 weekly EMA as well. Clear weekly down sweep by the bears, resulting moves higher. Any daily downtrend shift to the bulls would just be looking for a short-term lower high, depending on the size of the bounce. When we get to it, we'll tackle that. When we get to it, right, lower high, and then it's up to them to get the trend change. If the lower high is too shallow, you might just end up with a retest of the lows or even lower. And the monthly time frame similar, we are still in a monthly uptrend, but curling down fast into the 12 EMA, curling over on the MACD monthly time frame. You have to take notice of that. It lines up perfectly with our seasonality, February into March. The crush, we will see. Can we get favorable seasonality? But keep in mind, we will only get favorable seasonality if the market has favorable conditions as well, right? These issues potentially cannot be solved in the next 2 weeks before that April seasonality or end of March seasonality is supposed to start. We will keep watch on these markets. As I said, I'm not looking to predict the direction of the markets, guys. We will study the price action levels and adjust our trading strategy accordingly. For now, too much volatility, which is why my trading account, you will see a net pivot in terms of how much risk tolerance I'm willing to put at these markets with all of these catalysts now affecting not only the US economy, but global trade relations and the global economy overall. I think it's now a question of, solving all of those issues at the same time for the market has a clear case of bullish all-time high expansion. That is what you have to think of. Not, is the market finished dropping? What are the catalysts for pushing new all-time highs and expansion of the market? And as you may understand by now, we don't really have those catalysts just yet, unless the economic data shows that inflation is significantly declining, unless the jobs market proves to be very, very, very resilient, and unless consumer confidence makes a net shift, and that net shift also comes into consumer spending patterns. All three of those things we are still uncertain about. Moving on to financials right now. Financials also sacrificing the daily uptrend, right? Now, this is potentially an equal high. You can argue that, yes, it was a bit of a higher high, but we never really closed much above these levels. I will give this one to the bears. Daily downtrend is underway. Any bounce just looking for a lower high. Target this area right here. It was the previous support level that we blasted through, now below the moving averages as well. That is 51.30 down to about 50.8. Come into it like this, might be looking for a lower high. It's up to the bulls then to change the course of the daily uptrend, or we are just looking for lower lows. The banks, guys, have ran a ton. Now are pulling back, but look at JP Morgan on the monthly. A lot of space to move to the downside. Look at Visa on the monthly. A lot of space to move to the downside before the 12 EMA. Look at MasterCard on the monthly. A lot of space to move to the downside on the 12 EMA. Are you guys getting the point? Financials still have room to fall. So keep that in mind, guys. The weekly uptrend now also is forfeited, looking into support now, 48.27 down to 46.84. That is going to be the likely area that the bulls absolutely need to defend. Why? They are the monthly higher lows. If you flush these levels, it takes a long time for the bulls to get the monthly uptrends back. So keep that in mind. Moving into healthcare right now. Healthcare, usually one of the more resilient sectors in the face of a recession narrative. I'm calling it a recession narrative for now because the hard data does not say we are in a recession just yet. Inverse head and shoulders pattern that I was touching upon is now fulfilling the prophecy. The cup and handle formation pattern is now fulfilled as well. And we are mounting above this area of resistance, which is now support 148.75 down to about 146.50 above the moving averages as well. This is one of the sectors that is holding up the best across the entire market because of its more defensive nature. Bulls in complete control right now. Daily uptrend. Keep an eye on the higher lows, 147.13. You would not like to see the bulls close below this area right there, give back too much of this move, because then you open up the door for the weekly uptrend to be finished, looking to move lower with the rest of the markets. But overall, healthcare is one of the sectors that does look pretty good. My favorite play of the bunch is UNH. Quick little pop from support from the weekly 200 EMA back maybe to 520 or 530, 540. Decent little swing trade overall. Moving into semiconductors now. So semiconductors, we'll cover AVGO earnings tomorrow. AVGO was up roughly 15% in the after hours today. I think they tapered back a little bit of that in the after hours position close, up roughly, 18% at the max highs. 12% now, but you can tell they were coming off a day where they were down 6.33. So net, they're pretty much only up 6% right now. The damage has been done on AVGO. The damage has been done across all semiconductors as growth comes into question. NVIDIA earnings were fantastic. I covered them on the channel, but growth is the sector that's been hit the most. When you're talking about recessionary catalysts here and growth spending is usually the first thing that companies cut in this current environment, right? So unfortunately, SMH breaking down below now, possibly going to close below the 218.60 level this week if things do not improve by tomorrow. Tomorrow we have non-farm payrolls, a huge catalyst for the market. If you close below this weekly support level, guys, this unfortunately is like 6+ months of support. We were trapped between two levels, and I said, watch for the break. If we break towards the downside, they will then use this area as resistance, potentially going for lower lows. Not willing to call it just yet until the week is closed, but you can see a clear shift here in the daily downtrend to the bears pretty much, right? All the way since here. So any move higher, going to be looking for a lower high, maybe just to save this support zone. But if we flush below tomorrow, watch out, guys. You might be going a little bit lower. Lower high into lower low would not be surprising overall. My favorite companies to be bidding right now, slowly are TSM in the 160s perhaps. That will be a nice little consolidation phase for TSM, looking for monthly higher lows down here in the 160s, first little tempting position, and NVIDIA as well. NVIDIA in the lower 100s down to roughly $85, decently tempting area, but slowly is the key word, yeah? Monthly MACD curling over, monthly RSI curling over, monthly with a lot of momentum and a lot of juice. Earnings were fantastic. I still love NVIDIA as a company, but who's in control here? Short-term bears. All the momentum on the weekly, short-term daily, also moving to the downside to the bears. You have to notice what's happening right now, guys. Erosion of these trades. These trades will be fantastic trades, but you have to let the market iron itself out. Do not start catching falling knives with full size. It is fine to nibble NVIDIA on the way down. My fuller size positions will come in on a break of $100 down to $90, $80. That would be a top to bottom decline on NVIDIA of 38 to about 45%. Is it possible? Yes, it is possible, guys. Is it likely? That is up to you to determine, but do not say it is not possible. It is always possible, and as a result, I will be patiently waiting. If it does not come there, I will be waiting for the recapture of the weekly uptrend to position heavier in NVIDIA. For now, it is a question of waiting and nibbling tiny positions. For the positions with size, I need to see a new weekly uptrend, or this monthly consolidation leg is simply not finished, right? So that is everything for NVIDIA overall as pertaining to the semiconductor market. We'll take a quicker, more in-depth look at it later. IWM Russell down about 1.53 today. So the Russell down 1.53, guys. The Russell, I've been saying this for a while. This is not the trade to be in. We now have the weekly time frame rollover and crack below support. 208, not the environment for risk on, in my humble opinion. That is leading into monthly consolidation, and you got to be careful here. The monthly higher lows are set at about 195. We are now giving back a lot of this monthly uptrending move. High momentum to the downside. This is going to take a while to solve, guys. The risk on trade is just not here anymore. I would not be touching this trade. That's just my personal opinion. We're coming into the 200 weekly EMA at these same levels. The level of support down here is 196, 197. We will see how we react to it, but definitely any short-term bounces will be bounces into now resistance 216 to 208. This was support for the bulls for a very long time. We've now lost that support level. Daily oversold conditions, yes, but any bounce will be into resistance. And we'll see, can the bulls get the trend change or are we just moving lower? We will reevaluate this when the bulls make a move for a new weekly uptrend. Until that time, I'm not touching this one, guys, not touching it. Moving on to the Dow Jones. Dow Jones, same thing. We had a nice weekly downtrend into engulfing move, looking for the higher lows for the trend change, not getting it. Continuous flush. The bulls are giving back too much of this move, coming into final destination of support, which is going to be roughly 42,006 down to 41,900. That being said, if we do come down here, curious to see how do we react? Do we give the entire give back of the move and flush? If that is the case, monthly consolidation continues. You got to be careful as well. The monthly higher lows are here, 41,800. Crack below that, it is officially a monthly downtrend on the Dow Jones. A monthly downtrend does not get solved in 2 days of trading, guys. The Dow Jones may just have a little bit more room to fall. Look at the 12 EMA. 12 EMA on the 3-month quarterly time frame, guys. That would be a top to bottom decline of roughly 15%. It can happen. It has happened multiple times in the past. As I've been saying, the bears have all the cards in their hands to push the markets down if they do so choose. And this chart would not look awkward if we were to see a situation like this unfold over the next 3, 6 to 9 months of trading, right? So keep that in mind. The short-term bulls are still protecting levels, but the levels are being lost quickly. And we're approaching the 200-day EMA right now, which is also around that 42,000 mark. So we will see, can the bulls get a new daily uptrend into a weekly move higher, continue this weekly uptrend, or will it just be for a weekly lower high, lower low, erosion of the weekly, into downtrend, erosion of the monthly, into monthly downtrend? We will take a look at this one day at a time. It is not the time to predict whether this is the market bottom or not, guys. You have to sit and wait and watch for the price action to give you more clarity, right? Now, that is it for our major sectors overall. Touching upon bonds, you would expect bonds to be flying on days like today. They are not. Bonds are still yields are now just staying firm, right? They're trying to roll over a little bit. We will see if that actually continues into manifesting for a continued rally in TLT. The bond market not looking too bad, setting up the daily higher lows, possibly looking for the expansion as traders, institutions, and retail alike look for the safe haven trade. We will see what comes out of it, but definitely you would expect the bond market to be rallying a lot more than it has been in the last 2-3 weeks of trade, with the SPY and the QQQs down that much. So bond market is still a little bit tapered. Where is the safe haven trade? Well, I'll tell you where it is, guys. The problem with the bond market right now is that if traders believe in a speculation fashion, right? We've been talking about this now for the past 5-6 months since Powell started cutting interest rates. The 10 and 20-year yields do not move to a certain extent with the short-term federal funds futures rate. They move off of supply and demand for bonds. If traders largely expect interest rates, if they expect interest rates to maintain high or higher potentially because of inflation threats or just overall geopolitical threats and economy threats and stuff like that, they will require a higher risk premium, which is why people will be hesitant to buy bonds. They would rather sit in cash if they think they could get a better risk premium later, which is why I'm not willing to say that the bonds are the best possible trade right now. Are they a decent trade? Yes, but will they absolutely fly anytime soon? Possibly not. Very complex trade here as well. Not willing to call it either way, but if you have a long enough time horizon and we go into somewhat of an economic downturn, the Fed will cut interest rates. How fast the 10 and 20-year bonds will react to those interest rate cuts is, of course, anybody's guess. There is a lot of moving parts on this trade, guys. Do not get too overly ambitious with short-term call options on this trade as well. Gold as well. In this current market environment, you would be expecting gold to be absolutely flying right now. Is the safe haven trade of gold flying right now? No, it is not. That being said, the bulls are looking not too bad with price action structure. Still, the weekly uptrends maintained, looking for weekly higher lows for possible expansion of the gold trade, acting as a safe haven overall. This is trader and investor confusion at its finest, guys. All these safe haven trades, which should be popping off as a result of this volatility, are not yet popping off because traders are not too sure which direction to call it, which is also why I am not calling it as well. You can see there's so much uncertainty in the markets. They're not willing to call it either way. Gold is not skyrocketing. Bonds are not skyrocketing, even though equities are plummeting. So best to not commit too much capital to these safe haven trades until we have more certain directions. Is it a good deal to nibble on gold for that protective value? Possibly. Same thing for bonds. But are we expecting a massive rally on gold? Well, possibly. A lot of this uncertainty has been priced in to the gold trade over the last 6 months already. So I'm not worried, but I am curious to know how much actual more upside in gold you could possibly obtain with that size of that move already made. Moving on to Bitcoin right now. Bitcoin as well, risk off asset. Now, of course, we got some strategic Bitcoin reserve news over the last 2 weeks since we saw each other. And then more recently today, as President Trump signed it into action, unfortunately, no new funding by the US government. It will only be on confiscated funds. So traders were largely disappointed after the signing of that executive order that happened just about an hour and a half ago at this point, right around the 7:30 Eastern PM standpoint. That being said, below resistance, 92,000 to 88,000. This whole area right now, we are still tweaking around under it, yeah? Weekly downtrend is now clear as day. That being said, any resulting bounce is going to be for a lower high. It's up to the bulls to then change the daily uptrend and recapture this support area. Bitcoin is a risk-on asset. As of recently, we have seen the risk-on trade is not that prevalent in the markets as traders seek largely cash or safe haven trades. Bitcoin is neither of those. That being said, into monthly further consolidation, looking for a higher low, anything above 52,000 for that monthly higher low. Could we pull back again into the 77 or even targeting the 73, 75 former resistance, which would now be support area? Absolutely, guys. We almost got there just last week. It would not be crazy to see Bitcoin pull that move. It is monthly consolidation. We are below a key area of used to be support, which is now resistance. We'll see how this weekly candle closes, but the bears control everything. They control arguably the short-term timeframes. They control the weekly timeframes as well with this big sweeping weekly downtrend, and it is indeed still monthly consolidation. So further downside could be somewhat apparent in this market. And not only on that, but you guys have seen all of crypto, right? ETH, monthly downtrend now. Monthly downtrends take a long time to reverse into a monthly uptrend, weekly sweeping downtrend as well. No bottom clearly in sight yet. The next psychological bottom is going to be around that $1,900 to roughly $1,700 area on Ethereum and all the other cryptocurrencies, guys. If Bitcoin cannot keep it up, do not expect the altcoins to have any rally anytime soon. There's just too much uncertainty, too much volatility in these markets. Now, moving on to big tech names, and then we're done, guys. Going to keep this video probably about to an hour, 20 minutes, something like that. Tomorrow, we'll do more portfolio stuff. We'll go over a lot more trades as well, a lot more companies, right? But I had to do a massive recap because I hadn't seen you guys in like a week. So Apple right now, down. Daily downtrend on Apple, but Apple holding up better than most big tech names out there. 237 down to about 231 is the recent area of support that the bulls will be looking to back themselves up after. However, just keep in mind, guys, lower high. If we go for the lower low, keep an eye on 220. If you get a flush of 220, that is a new weekly downtrend on Apple. That would be synonymous with monthly consolidation too. And at this point, the monthly higher lows are set right now at 220 as well. Lose this, you lose the monthly uptrend, and you're probably going a bit lower. 204 down to 205. It would not be surprising on Apple to join its sector peers for a decline of roughly 20%. Several names are already down 20%. And when you're trading at a 3.17 peg with not that much revenue growth to show for it, and your flagship product also is declining, right? In several markets, it might just be a matter of time before Apple gets dragged down with the rest. It's being upheld largely by buybacks right now and investment plans into the United States. Apple is known to be one of the more resilient stocks in the Magnificent Seven, showing those quality characteristics right now as well. But if we get further breakdowns of the support range, we're going to the 220 range quite quickly, and then you got to pay special attention to 220. I am not buying Apple here. Not for a swing trade, not for a long-term portfolio. Apple, for me, would only become one of those two things in the lower 200s. I have long-term shares. I'm not touching them, but am I adding any swing trades here in these market conditions? No, I don't think it's one of the best deals in the market. Moving on to AMD. AMD down another 2.77%. And now AMD, guys, is coming up to the last line of defense, which ends at about $95. Flush 95, and then this entire zone becomes resistance as well. And the next stop, unfortunate for me to say, is about $85. Yes. $85 is the last area down there. Sweeping downtrends all across the board. No secret here, right? Even despite its fundamentals, guys, in this market right now, fundamentals apparently don't matter at all. This one has been cheap for a while, but growth and semiconductors have not been the more favored trade in the most recent few weeks. Monthly downtrend is for sure. Weekly downtrend is simply perpetuated at this point, another lower low. Any resulting bounce on any of these time frames, I'll remind you what we're looking for. We're just looking for a lower high, then it's up to the bulls, depending on the size of the move, to reset the daily uptrend, give me a nice daily uptrend, then we can talk about a weekly uptrend recapture, and only after that we can talk about possibly even a monthly uptrend recapture, which is a long ways away. So AMD, once again, this is another nibble trade. Nibble, nibble, nibble. If you believe in the long-term thesis of the company and you believe it to be undervalued, you believe it to be expanding over the next 1 to 2 years in terms of free cash flow, gross margins, net margins, revenue, and EPS, it is a nibble trade at these reduced valuations, not an absolute go all-in trade, because we know that even though AMD is cheap, if the rest of the market continues pulling down and the SPY and the QQQ are not done dropping, this one will get dragged down another level, unfortunately. Moving on to Amazon now. So Amazon as well. Top to bottom move on Amazon at this point in time, guys, is now 17.5%. You may say now is possibly the time to be buying. And I would agree. It is a nice time to nibble. 197 down to about 185 is the most recent area of support on the monthly timeframes. When in doubt, zoom out. You'll see me losing a lot of monthly timeframes here. We're coming into the 12 EMA. Previous resistance, which should now be support. However, the bears are in full short-term control. Massive slide, massive daily downtrend right now. Lower lows not being set just yet. What the bulls need to do is keep these equal lows, break the highs of yesterday, 210, reset a daily uptrend. Then we look to the weekly time frame. How much of this weekly move can we recapture and then try and reset a weekly uptrend? As of right now, with the size of this engulfing move, it looks like the most likely scenario will be a lower high. Can the bulls then manifest that lower high into a weekly trend change? Or will it just be a shallow bounce weekly lower high into further consolidation, which might bring us down 196 to 187. The absolute max pain level for Amazon, in my opinion, would be 175 to 160. So can we be net buyers of Amazon down here? Sure, but half size positions or small size positions or just DCA for long-term portfolios. Maximum pain is a pullback of this 3-month quarterly time frame back down to the 12 EMA, which is 166 ever so roughly. It would not look so awkward, and that would be a top to bottom decline on Amazon of 25 to 30%. I'm not saying it's going there. I'm just giving the idea that if it does come down there, I'll be committing a lot more size to the trades that I am at this current level. But Amazon, decent buy. Moving on to Google right now. Another company that it's in a very decent buying opportunity territory right now. That being said, Google does have its suite of issues. They have the Department of Justice lawsuit coming up in the month of April as well. Sweeping weekly downtrend at this point. Lower highs are set, right? No daily trend change just yet. Higher lows are trying to be set. Going for the daily trend change under the 200 EMA. We are trying to battle it out in support right now. 178 down to about 170. Lose this or we get a resulting bounce, daily uptrend bounce right now, right? What are we looking on the weekly here, guys? Who's in control of the weekly? Loss of the weekly time frame, you'd be looking for a lower high, and then it's up to the bulls to change the weekly trend. If they cannot get it done, we are looking lower. The next level lower for Google, once again, sucks for me to say, I know, is the lower 160s. That's just where we're going on the higher time frames, right? Prior all-time high support, prior area that we bounced from recently, the 26 EMA is down there as well. That is max pain, in my opinion, for Google through this cycle decline. That will be 25 to 31% down. I'm not saying it's going down there. I am saying Google is a very decent purchase at these levels, but can we go lower? Absolutely, guys. And it should not be surprising to each and every one of you if we do revisit those levels, not in one shot, but maybe over the next 30 to 69 days. Can there be violent upswings, violent downswings all throughout, resulting in a culmination drop after some time? Yes, and I'm putting that front and center for you guys. Just watch 3-month time frames here. Curl back in the 12 would not be something crazy to see. Moving on to Meta right now. Look at this one on the 3-month time frame, right? Eventually, Meta can pull back as well. Fantastic company, fantastic fundamentals. None of that matters right now, right? Daily sweeping downtrend, lower high is set right there. Coming into support, 633 down to about 618. If we break below that, the next area is 598, roughly 600 down to about 580. That being said, who's in control right now? Well, it was the bulls, but now we are losing ground very rapidly. Big sweeping engulfing move by the bears right now. the most likely scenario is if we do get a nice bounce on Meta, daily uptrend shift, we're looking for a weekly lower high. It's up to the bulls then, get the weekly up, or rather continue the weekly uptrend. A V-shape would be somewhat unlikely at this stage in time. If we get too shallow of a bounce though, weekly downtrend will be underway. You will then be looking at monthly consolidation, possibly retesting the 12 EMA around the 564, 550 level. That would be a top to bottom decline on Meta of roughly 24%, a very decent area to go shopping for this fantastic company, long-term portfolio or swing trade. But for either of them right now, it is just a little bit too high. Moving on to Microsoft right now. So moving on to Microsoft down 1% today, again, struggling to maintain this 400 level. They are trying desperately to maintain the support range, 407 down to roughly 392. The weekly candle does not look too bad, but we have non-farm payrolls tomorrow. That being said, the daily bulls are doing a good job, engulfing move, looking to reset into a new daily uptrend. If they cannot get it done and we roll over tomorrow, guys, understand who is in control here. It is the weekly bears. Weekly downtrend is set, looking for possibly a lower high, using this whole area, right? A challenging zone. If we flush below, we are coming right back down here, 378 to 364. Still one of my favorite companies in the long-term portfolio to add right here. And also for some small-sized swing trades. But for the larger size, I will now be reverting to the lower levels, 375 to roughly 364, which is the previous flush zone back here, previous area of support. It will be further extension of monthly downtrend consolidation into the 26 EMA. And on the 3-month time frame, well, you guys get the point. Looking for the higher low on the 3-month time frame, 12 EMA. 12 EMA, right? When in doubt, zoom out. Move on to Netflix. Netflix was almost down 10% today. I was warning about this one, guys. It had just gone straight up without much consolidation. Now we get the daily downtrend flush. Now we're almost through support, 933 down to about 899. Not the best look for Netflix, giving back a lot of this move. 26 EMA is going to be the next area to watch out for. But as I said with the rest of the charts, right? Any move higher, looking for a lower high, possibly for further downside consolidation. The valuation on this one, I'll remind you, even after earnings, after 1,000, was about a 1.83 peg. Netflix has room to fall. Even by setting all these records, they can't have room to fall, guys. It is just normal consolidation. So even though the weekly bulls are not looking too bad, any further declines opens up the door for lower high into lower low. I'm not saying it's going to do this, but can we get just some chop? Weekly consolidation, which leads into monthly consolidation on Netflix, which desperately needs it, coming back to the 12 around 800. Yes, indeed, that is possible. It is weekly overbought conditions, monthly overbought conditions as well. Coming off the weekly overbought, no longer weekly overbought, we are still monthly overbought conditions. Can it curl back down like Meta? Absolutely. Next stop is 800 for those longer term timeframes. That will be a top to bottom sell-off on Netflix, 25%. Are you starting to see a parallel here? 20% plus sales on big tech are indeed for buying, but the pain does not have to stop there. It can go lower, but that is a very decent area to base a lot of our first positions off of. Moving on to NVIDIA right now. NVIDIA down another 5.74%, straight shot down by NVIDIA. Daily downtrend is clear as day at this point, no end in sight. Any bounce from here looking for a lower high with the moving averages to contend with, and then can the bulls get a trend change? Or will we just continue rolling over? That is anybody's guess, but we are challenging the bottom area of this support level, which is pretty much 115 down to roughly 110. We're right there right now. If we get any further declines here, guys, weekly downtrend is significantly underway. You got one last guy here at 103, then it's a psychological 100, and then, unfortunately, guys, the next big area is all the way down here. It is roughly at about $91 to about $82. So, is it a good buying proposition to nibble on NVIDIA? As I was saying earlier in the video, absolutely. But to catch NVIDIA here and say this is the absolute bottom would not be prudent risk management. This is a weekly downtrend unraveling right now, which we have not seen on NVIDIA since all the way back here, yeah? And back here, it started from the same levels, and it did touch 93 off of that Japanese carry trade in August. So it would not be too far-fetched if we were to revisit these levels. Monthly MACD, be careful. It is still one of my favorite companies in the market. We're getting close to being somewhat undervalued in terms of the next 2 years of growth. But, watch the 3-month time frame. Can we test the 12 EMA? If market conditions deteriorate over the next 3 months, yes. And that is what this chart does show. Moving on to Tesla. I'm not saying any of these are going to do it, but you have to focus on the bull case scenario, the normal case scenario, which is just price action now and current levels, and the bear case scenario, right? Moving on to Tesla right now. Ooh, Tesla, not looking very good, is it? So sweeping daily downtrend continues to be clear as day right now. Lower high is set at 299. We are now blasting through our last line of defense, which is roughly 303 down to 268. We are now crossing through it. Weekly downtrend is clearly in motion. Weekly is not yet oversold. The daily has been oscillating, oversold or not. Can we fall lower on Tesla? Yes. Tesla is a game of narratives right now. Here, the narrative that Trump and Elon was going to be a very good narrative. Now, the pushback from people that aren't necessarily supporting the actions that Elon is taking with his endeavors with Doge. I'll leave that interpretation up to you. I'm not here to tell you guys whether it's a net negative, a net positive for the economy, for Elon and Tesla as a brand, but the perception right now is one of overall negativity. You are seeing people pull back on spending for Teslas, namely in Europe and other countries affected by US tariffs, namely Canada as well. I can tell you that people here are somewhat boycotting the Tesla brands and things like that. These are just the facts. I'm not here to say whether that's right or wrong, but these are just the facts. So can Tesla go through more pain? Yes, because those facts cannot be reversed with the snap of a finger, right? We know several things have been good for Tesla, such as made in the USA are now going to get tax rebates for interest rates essentially on those cars. But keep in mind, Tesla stock is roughly overvalued. The last time I did the valuation after earnings was at 407. It was a 6.1 peg. If you drop this to 203, which is half, you're still trading at a 3 peg. That is very high. The next line of defense for Tesla will be at this 200 weekly MA, which is roughly at 233, which is the bottom end of our area of resistance. These guys down there. That is the next stop for Tesla if we have further momentum to the downside. And we just get the unwinding of the bullishness that occurred over the month of November and come right back in the same areas where the stock found a local bottom before. 230 pretty much down to roughly 200 psychological is going to be the next area of support for Tesla overall. I myself, even though I am a Tesla shareholder, think that there's too much volatility on the stock for me right now. As a result, I'm not going to be trying to play it for any long side risk reversal trades just yet. I need to see a local bottom form on this stock first, get a better glimpse into a level, and wait for the trends to cooperate for a net long. Net shorts, I mean, the stop loss should be about 301 and you're targeting roughly the lower 200s. Still a decent 2-to-1 trade to the downside with the stop loss up here, but we are daily oversold. So shorts, can get squeezed as well. Palantir down 10.73%. Palantir, we are seeing these growth trades getting unwound one after the other. A few weeks ago, people were saying Palantir was going to $150, $200. It just could not be stopped. Throw in a little bit of economic uncertainty and growth scares into the market, and it's funny that valuations start mattering again. I go now everywhere on the timeline on Twitter, and even though people are still bullish, people are now focusing on the valuations, right? And at $100, the valuations were extreme. I'm here to tell you that at $80, the valuations are still extreme. You're talking about a 6 peg. I haven't redone it right now. A 6 peg and still arguably probably a 45.50 price to sales. That is very, very high for this company. So are the good best times behind us on Palantir? Depends on your time horizon. But short term, I would be highly surprised if the markets just reverse and Palantir just goes back to the all-time highs. I think this one is in for, let's just call it an extended phase of consolidation. Daily downtrends, no new net lows, currently bouncing off support, 83 down to about 77, lose 77. Daily downtrend is reset anew. We are losing the last line of defense area of weekly support, and this will be a weekly engulfing move, the result of which can just be a lower high into lower low, further weekly consolidation, and potentially into monthly consolidation as well, which Palantir desperately needs. This is the monthly closing candle from February. It does not look too good, does it? Can we potentially pull back to the 60-55 area, which is the touch of the 12 EMA? Yes, and Palantir has done this several times in the past, so nobody should be surprised if that is a possible occurrence in the future as well. I'm not saying it's going there. I'm just saying if it does go there, it will be a very logical chart pattern that Palantir has followed itself in the past, especially coming off of extremely overbought conditions and questionable valuations. And I say that as a Palantir shareholder myself, with shares I acquired at an average cost of $11.87, guys. I'm still in this one. My total position leading into this move was 1,800 shares. I'm now down to 500 shares. Suffice to say, I have trimmed a lot of the position, right, to the downside, and only will re-add if we get to much more manageable levels. Moving lastly into SOFI, SOFI as well, another great growth story, has quickly come undone in the markets despite having a relatively fair valuation on this one at 16 bucks. The peg was a 1.12. At 12.45 right now, we are under, but as I've said recently, valuations for tech, even though they're looking cheaper now, they just do not matter, and the technicals are not being respected as well. The effects that are plaguing the markets right now go over and above all of that. So, starting from the top, right, daily has always been a daily downtrend. Daily downtrend is clear as day. Lower highs are now set. Actually, this is one single move. The lower highs are right there, 1480. Any resulting bounce looking for a lower high using all the above area, unfortunately, as resistance. 14 to 16 now becomes resistance. They held it as support for a very long time. We have now lost that level. That becomes resistance. Why is that important? Because we also have a weekly downtrend. Any weekly bounces going to be looking for a lower high. It's up to the bulls to prove it to us thereafter, but the resulting bounce will be for a lower high. We'll study the size of the bounce thereafter into resistance possibly. And if we do not go there, if we just flush until the next area of support, the next area of support for SOFI currently at this time is $11.70 down to about $10. Yes, the liftoff zone where we cracked out of previously. This would be a tremendous buying opportunity for SOFI. I would not hesitate to be adding more shares to my position, looking for extended monthly consolidation back into the liftoff zone, back from IPO as well. This would be a very logical area for the bulls to build more of a shelf of support before potentially embarking and trying to crack these upward levels once more. So for me on SOFI, it'll be a question of DCAing, but keep in mind monthly consolidation can take months to undo and recapture into a proper trend. So keep that in mind. That is everything for your market rundown today, guys. Apologies for the longer video, but I think it needed to be done because I hadn't seen you guys in a while. I missed you guys. Hopefully you guys also appreciated this video. If you did, consider dropping a like. Would appreciate it for the growth of the channel. Also consider subscribing. We do these videos now back Monday through Friday. Regular programming will be back. They won't be this long because now I've put everything on the table, but you guys now know where I stand. And lastly, if you have any questions, of course, please leave them down below in the comments. Today and tomorrow, I'll do my best to catch up on all the questions that have been left on the channel so far. And as I said, tomorrow we'll be doing an update across many more stocks and sectors overall. So that should be a very fun video. AVGO, Marvell earnings, take a look at semiconductors, and all of my portfolio rundown as well. I'll give you guys a more of a glimpse into how I'm approaching trading these markets and why I have also pivoted to a more risk-off mentality in terms of the trading account. Long-term portfolio, no, we're still buying. But the trading account, I am now doing something, guys, that you have not seen me do in the last 2 years. Because of all these overall catalyst shifts. I gave this analogy right to my Discord members today, right? And the best analogy is a poker game, right? So you've been used to calling the other player's bluff, right? Now, for a very long time in the poker game, you're the large stack at this point. You have 2 years, plus 2 years of gains, at least since we've been together on the channel, right? Very substantial amounts of gains on the channel. You have 2 years of gains, and every time that you've made very logical, educated guesses with the data, you've called the other person's bluff. However, this time, right, you're used to calling their bluffs, you know how they play. But now this time, they're doing a strategy that you haven't really seen before. It's a very complex strategy, right? A very complex strategy in the sum of all its parts. Do you want to continuously call the bluffs, right? On this, because this might be the one time where the other player is holding the absolute nuts in your face. And if you call the bluffs up here with SPY only down 6% off the all-time highs and the Q's only down 10%, and you could go double or maybe even triple that, well, your stack is going to be greatly reduced. And this is the only time, guys, on the channel that will be front and center and say that I do not want to call this bluff. You guys are free to do what you want. It is your money. It is your accounts. If you love risk in the markets, if you want to call this bluff, if you think that this is the end and this is the bottom of the absolute drop, and you want to go all in plus margin and go for the all-time high expansion, then it's up to you guys. You can perfectly go for it. But as you know, I'm very honest on the channel. I'm very transparent in this environment where I am telling you guys, prior, I knew with a very good degree of confidence which way the markets were able to recover, which was to the long side. I was telling you guys, I'm still long and strong in the trading account and still 60 or 70% bullish overall in my trading style. Now we have a lot of catalysts that go over and above what's happening only in the USA. And these issues, some of which cannot be solved instantaneously. That being said, I do not know, guys. Nobody knows right now. If somebody tells you with a categorical yes or no answer that they know where the markets are heading in the next 2 to 3 months, guys, they don't know. Nobody knows. Nobody has that degree of a crystal ball. And when I do not have a certain degree of confidence in net long positions, I do not do them, guys. So now you'll start to see a lot more risk management on the channel, a lot more risk averse positioning, a lot of hedging and bearish positioning as well, and a lot fewer trades on my part as I seek to protect the large stack that I've accumulated in the last 2 years. We will buy methodically, but it will be just that, methodically and very cautiously and carefully, and wait for the market to come to me in my desired price level. So hopefully you appreciated the video, guys. I'll see you back with another great video tomorrow, and we'll get through this correction together. Take care. Thanks for watching, and peace.